Hello again and welcome back. This is Rick Miller with His Capital, and if you remember in the beginning of the video series where we talked about our assisted living facility strategy, we talked about why we felt it was such a great investment. And then we started talking a little bit about how our operator executed on the plan to actually take action and invest in the assisted living facilities. Today what we're going to do is share with you a little case study and talk about some of our future plans as a real estate investment company and how we intend on maximizing and growing in this specific strategy. So let's begin with the story of how this started. As a real estate investment company, we lend money to other active investors, so we do a lot of bridge funding. And this is exactly how we came across this opportunity. We had a client that we worked with over the years who generally bought fixed and flipped homes. He also bought and rented properties. And he got to a point that he wanted to change his strategy so that he didn't have to compete with everyone else that was flipping and everybody else that was becoming a landlord. And so in doing his diligence, he decided to buy these 3 properties of which we helped finance. He repurposed them completely to turn them into residential assisted living facility. And I love the impact that we've been able to see happen in the lives of the people that actually go to these beautiful homes that he's transformed. Now let's talk about, as we break down this case study, the 2 key pieces. So I'm going to separate it now. We're going to go into the real estate first, and I'll give you those basic numbers, and then I'm going to show you the business case study so that you can see the value growth and the cash flow of the business separate to the actual real estate itself. The first important note to note is that, first of all, the location of the 3 homes was actually in Carrollwood, which is zip code 33618. Now, the reason why I say that is because the real trick to these 3 properties and being able to scale that business was in finding the properties within 1.5 miles of each other. So that way management can still commute to all the properties and you don't need to hire more people to actually manage a business. So that was step 1. The next component that was really important was the basic demographics, as we've talked in the past. So in this particular area, 20% were owners that were 65 years and over, and the median salary in that area was $54,371, showing us that the numbers support the ability to pay the actual services that we offer. Now, as far as the sizes of the homes, each one averaged about 3,500 square feet. And now let's take a look at the actual layout of the bedroom count. So these 3 homes all had something in common. They were either converted into 6 bedrooms and 6 bathrooms, or they already came with 6 bedrooms. So the actual 6 bathrooms were the ones that we had to configure. Now, the capital improvements that had to be put into the property in order to actually make sure that they were approved for this type of investment opportunity, you'll see in house 1, there was over $255,000. House 2 was $120,000 to upgrade. And lastly, in house 3, there was an investment of $177,000 to make sure that these homes were a perfect fit for the business model. Now, once those assets were completely renovated, we did a valuation on the properties, and house 1 appraised at $660,000 with this new upgrade. House 2 was worth $535,000, and house 3 was worth $650,000. Now, when you take a look at this, that's a little bit over $1.5 million invested between the purchase and the actual renovation of the project. But you still have equity left in the property that will continue to grow over years. But what makes this investment amazing when you separate and compartmentalize your business is that on the real estate side, it was structured in a way that there's a triple net lease, and that is about $144,000 a year, which means that the business takes care of all the operating expenses of the property, including the property taxes, and the real estate holding company is just getting net rents of $144,000 a year. So from a full-on investment perspective, secured by 3 single-family properties that are generating cash flow, the real estate side is making a cap rate of about 9.3%, which is a pretty solid rate of return when we're only talking about 1 out of 2 components of this investment. So now let's talk about the business aspect. And the average rent that he's charging per bedroom was $4,000 a month for the actual care that they provide in these beautiful, beautiful homes. Now, what's important to note is that that is $4,000 per bedroom times 3 homes that have 6 bedrooms each. So you can do the math and see the cash flow start stacking up. You have operating expenses for the real estate lease that we just talked about, that triple net lease, which would average roughly about $4,000 a month per house. You also have, of course, you have to deal with food, which you provide for the entire home. Generally, on average, based on the numbers that I've looked at here, is about $1,250 a month supplies the food for the actual families that are there, the people that are living in the place. From there, we talk about basically the actual caregivers themselves that are the actual pros that are responsible for making sure that the actual service is there, that they're cooking, they're cleaning, they're doing all the services for these individuals. It's about $11,000 a month. You have taxes, you have insurance, you have utilities, which is another $1,500 a month. And so when you really break it down, each property is producing a net operating income pretty much after covering all those expenses of about $5,250 per month. So you would multiply that times 3, and you can see how having a 3-pack investment can be a very lucrative business model for cash flow purposes. Now, what is the exit strategy? So because I came in as an actual private lender, I was secured by the real estate side, but I also had security in the business, meaning that if he defaulted, I could go after the business in addition to actually going after the real estate. Now, what's cool about this, and in a minute I'll talk about other ways that you can be involved in this type of business model, is that the cash flow from the business more than covers our expenses and our income. Once the value of that business grows and the cash flow consistently grows, because of the cash flow stream, this particular business model will be able to justify doing a refinance to pay off the mortgage with an SBA loan that will lower the interest rate substantially much more than what you're dealing with right now when you're dealing with private capital. So I wanted you to gain perspective. So he bridged with our money, stabilized the asset, and now that is producing the cash flow. Not only has his business grown in value, in fact, the value of the business itself per property is roughly about $185,000 in value based on the income stream that it generates afterwards. So he's got a valuable business that now he can refinance with an SBA loan, pay us off, and now he's got permanent financing with really low rates. And that's a perfect example. Now, another way that we're incorporating an exit strategy is that as a real estate investment company, his capital has launched his third fund, and it's a Reg A offering, which allows us to offer these investment opportunities to people nationwide. They don't have to be accredited, and they can start with as little as $5,000. So for those investors that get these numbers and say, wow, this is amazing, but honestly, Rick, I don't have the $1.5 million to invest. Some of you might say, I may have some of that, but I don't even have the time. Well, you see, this fund allows us to empower investors like you to participate in these kind of deals without necessarily doing all of the heavy lifting. And you can be involved with as little as $5,000. So that's the beauty of leveraging the fund. Now, as we move forward, this is just a 3-pack example. What I really love about what we're doing right now is we're looking to grow and scale the rest of the business. So let me share with you one more strategy that we're implementing in order to stay single family, but still maximize the opportunity to the best of its ability. And so what we decided is we have some land in Lakeland, Florida, and we're in the process right now as we speak of creating a small little subdivision that will be specifically focused on residential assisted living facilities. And the way we're going to do it is we're in the process right now of drawing it up. We want to have anywhere between 15 to 16 bedroom homes that are roughly 55 to 6,200 square feet. The idea is we want the house to still be a house. We want somebody to be able to be there and feel at home, but we want to increase the capacity of occupancy so that we can increase the cash flow. Because remember, the more people that you actually have in one place, the more you can justify having better health care, but at the same time, you save money in the operating expenses. And so that's one of our biggest goals right now. Now, you might say, Rick, well, this is building from ground up, and you're right. The first one was buying homes, but if you want to take it to the next level and you really want to configure it, then ground up construction is the next strategy, which is what we're planning on doing with this particular project. Now, if you're considering investing, I'll leave you with this thought. Like in this case study, a lot of people will ask me questions and say, Rick, exactly what do you think it takes as far as time? And it's really straightforward. If you are considering being a passive investor, somebody that's just going to put money in an endeavor like this, well, literally based on your due diligence and based on the criteria we're happy to share with you, really you could consider investing in something and be there as quickly as 30 days. If you want to actually buy the land and go ahead and go through the process of drawing it, developing it, and building it, you can expect 12 to 24 months, depending on permitting, to be able to build these types of structures. In my opinion, I just feel that ground-up construction would be the next level for us, just simply because of the fact that we're able to build something custom that still keeps that experience for our client base, but increases the profitability at the same time. So hopefully this video has been valuable to you. If you want to learn how you can be a part of projects like this with as little as $5,000, check out the website, and we hope you enjoy this information. Thank you.